Good morning, everyone. Hope everyone had a happy Thanksgiving. Stocks are mixed this morning, but they're coming off four straight weekly wins. The VIX and the volatility index in the stock market is at its lowest point in over a year and is below a level of 14. The 10-year bond yields are below a level of 4.4%. The stock market and the major stock market indexes are having their best November in nearly a century. Specifically, that's really for the S&P 500. It's one of its best Novembers in nearly a century. There's more evidence of a risk-on environment because Bitcoin hit a new yearly high of about 38,000. It's good to really see this, the market regaining this momentum again. Coming into this year, many investors were bearish on the stock market and thought that the stock market might hit new lows early this year. I honestly made a video late last year pretty much saying, although there's a chance that the market could dip, we should likely hit the all-time highs that we had back in January of 2022 this year, which would mean an S&P 500 level of 47 to 4,800. Investors were bearish because they thought higher yields would really hurt stocks. And that simply wasn't the case. The market sell-off was last year. And in my opinion, the recession was still last year. Last year, we had 2 negative quarters of GDP growth, peak inflation, and stock market lows. I don't think this is a bear market rally that we're experiencing now, because if that was the case, first, this would be the longest bear market rally in history. The market's lows was back in October 22. And now we're already in November. So it's already been over a year of the market gaining momentum. And I really don't see the market making new lows again. We might dip a little bit at some point next year. But ultimately, I think the market will continue its upward momentum throughout 2024. Hedge funds were placing bets last week that the market would go down, and they had $43 billion of losses. I think the market's momentum, as I said earlier, will continue. There was some good news that we saw on Wednesday of last week, OPEC extending its meeting. I think, first led to oil prices sliding to below $75, which helped stocks at least on Wednesday and Friday. And I think still will likely be a catalyst into this week, somewhat at least, that will likely lead also 10-year bond yields going a little bit lower, as well as the dollar going a little bit lower, which I think is good. But I also wanted to touch on good news in terms of Black Friday online sales. They hit a record. They were up 7.5% from the prior year, and they came in at $9.8 billion. That's huge, and that shows that the consumer is still very strong and intact despite the Federal Reserve hiking rates aggressively. Look, a lot of that is consumers taking out credit card debt in order to make ends meet, because credit card debt is currently at one of its highest levels ever, at about $1 trillion, and consumer excess savings, has deteriorated and went down pretty significantly, at least over the past year and a half. But either way, that's good because consumer spending is set about 70% of economic growth in terms of GDP. So that's good news to see. Another good sign is that the geopolitical situation in the Middle East seems to be thawing out and becoming at least slightly better in terms of hostages being released on both sides. That shows that the geopolitical tensions aren't intensifying and other nations aren't being brought into the war. The fact that the geopolitical situation isn't intensifying and hostages are being released is good for the markets, and is another reason why I think the markets should do pretty well if at least that continues, if both sides meet their commitments. And then this coming week, we have some economic data that's pretty important and investors are taking a look at, especially consumer confidence data and pretty much core PCE inflation data, which is the Federal Reserve's preferred inflation metric. Investors are looking at that pretty closely to see how we're doing on inflation. And then we also have new and pending home sales to see how the housing market's doing. So that's very important for the markets. And look, this week might be a little bit of a consolidation trading sideways week. There might not be that much direction because investors are anxious about the inflation report, the PCE inflation report. Look, I'm not sure if we'll into year end gain 5% more from here, but there's a lot of catalysts that investors' money on the sidelines might be chasing into the gains we had in this market. And I wouldn't be surprised if we did trade at least 5% higher from here. Look, there was a chart I found over the weekend showing the stock market since 1982. And you could obviously extend this out through, since 1900, but the chart I found was since 1982. And despite, Paul Volcker in the 1970s raising rates and crash, and which, created a recession because first of the inflation that was from the late 70s and then him raising rates aggressively to fight that inflation, it led to a recession. But after that, it led to a huge boom into the 80s and 90s. And then obviously we had the dot-com recession in 2000. And then followed by in 2008, the great financial crisis recession. And then obviously we had the COVID pandemic. And now in my opinion, was a recession from last year into early this year with the Fed hiking interest rates aggressively to counter inflation. But despite all those recessions, pandemics, the stock market still manages to trade higher throughout long periods of time, which is pretty optimistic in terms, at least for me, in my opinion, and why in the long run, I always view stocks as a great investment.